Right, so this takes us into the session on remortgaging. So as I said, this will probably take around 20-25 minutes for what I need to cover off. And then obviously in sort of 5-10 minutes for Q&A, or really as much time as you want. So as I say, if we can keep questions to the end, if you've got any questions, just type them into the chat box. Once I've finished the presentation, I can then see any questions and then we'll go through them from there. So if we get started on this then. So hopefully you can see my presentation. So this is us. So I've sent, this is vastly our clients and some people who sort of are looking to work with us as well. So you should be sort of fairly familiar with us guys, but just as a very, very brief recap. So we're a whole of market brokerage. We obviously do all different types of mortgages, but this is very much focused on remortgaging today. So if you worked with us previously, fantastic. This will be a good sort of recap as to sort of what we might do coming down the road. If you haven't worked with us, this is the sort of thing you can look to expect. So today is looking at remortgaging and a sort of subheader there of how to get debt free faster. Our company just has two very simple principles, which is one, we want to get our clients debt free, which is a bit weird for a sort of mortgage broker to talk about because you think we're peddlers of debt and we love it. Ironically, we don't. You know, I'm the human as much as you guys. You know, I've never met someone who doesn't want to be debt free. And actually, the way I view this, I've done this for a very, very long time, over sort of 20 years now, mortgages, is that if you know how to manage debt down, which is this is very, very much about, you can save yourself, I mean, tens, if not hundreds of thousands through the lifetime of a loan. So that's very much what we're focused on today. Specifically, what we'll cover is what's going on in the market, what's changed, what's possible, how to improve your credit score, and explain why that plays such an important role specifically in London, how much you can borrow and how your income's assessed, and again, lots of change on that in recent times. How to navigate the market if you've got a complex income. Again, we may or may not talk to too much detail. As I said, how to save tens of thousands of pounds over the lifetime of a mortgage. It sounds like a lot, but it's so easily done. I'll show you how easy it can be to save that much money. And how to become independently wealthy in 3 easy steps. That sounds like a bit of a shyster comment. It's really not. I'll explain. It's deadly simple, but it's really hard to do because it takes about 20-30 years. But I'll explain it because it's anyone who's worked in sort of independent advice or financial advice is a wider thing. There's some really basic principles that underpin everything, and they're sort of getting lost. So I'm very old school. You know, normally like to meet people. Obviously, that's not possible right now, but this is sort of the closest we can do. But I just want to share some thoughts on that because it is really, really important. So first bit. So what impacts have we had on the market? So the biggest thing, if you've been following this sort of closely, is that obviously with lockdown, is surveyors were literally locked down. They couldn't go and see a property. So for a bank, that's a problem. You know, if you can't go and look at the asset you're lending on, how much confidence do you have to offer a loan to someone? So that was coming into this was like the biggest headache. I was actually staggered at how well banks responded. So we're looking specifically in terms of remortgaging today. Now, a lot of banks offer free surveys and have done for a long time because what they do is they use what's called an AVM, an automated valuation model. So say, for example, you bought your property 2 years ago at X price and house prices have moved up, say 2% in the intervening 2 years. Well, banks know that your property is worth whatever you bought it for plus 2%. Pretty simple. So that's why banks have those models, use them for a very, very long time, and they've done them primarily in the remortgage space. Now, we're not going to talk about it today in any detail, but how banks pushed that out into purchase market was phenomenal. But also the robustness of these models is what I was impressed with. So you can see sort of the limitations here. So even, I think, even for the first month or so, there were some banks lending at 95%, which is sort of, that shows a lot of confidence in the models. But even as we sit today, so how is it possible to sort of refinance your property? Well, now surveyors are back out on the road. But one of the big changes we're going to see going forward is a lot less surveyors being used because banks have proved their models and their desktop valuations. So all sort of the automated tools they use have been so good, they just don't need to rely on surveyors so much. But you can see that it's pretty generous what you can do. You know, you can borrow 90% of your property value up to £500,000, 85% up to 3 million. And if you have more than 25% equity or not, you can really do whatever you want. Now, obviously, getting debt free isn't about ladling you with debts. I'm not suggesting you do this. I'm just saying, based on your situation, if you think I'm quite highly geared, can I do it? Well, actually, it's fine. Like for most people, that's going to be fine. It's very few where that doesn't work. There's lots of exceptions around this. I won't talk in any great detail, but you know, generally, most high street guys are comfortable up to about 85% of £1 million, which is generally okay. And obviously, the bigger deposit you have, then great. Loan to values might be lower. I've put a little sort of disclaimer on here if you're doing debt consolidation or interest only. So that's what banks will do. But then depending on your situation of what you're doing, certain banks might offer lower loan to value. So say, for example, really simple example, if your property is worth 100,000 and you want an interest only loan and you're consolidating debts, well, a bank might sort of say, well, actually, you can only borrow 75% of the value of that property, and some banks don't let you debt consolidate at all. So there's certain little rules around that, but that's how that works in practice. Next point really was, how have banks been defensive in their criteria? They sort of yes and no. So lots of banks sort of take very different stances through this period. So probably the one area now that I think banks need to be really cautious on is if you've got variable income. So that captures anyone with bonuses, you're self-employed, if you work on commission, that sort of stuff. And that's not to say that you can't do it, and I'm going to explore this in a bit more detail a bit later on. But I'm just saying, if your income is made up of bonuses, variable income, or you're self-employed, you do need to be quite careful about what banks you approach. So just to be really clear on that. We're a broker, so we're not really concerned that one bank's taken a position over bank B. We just put you with bank B. It's really simple. Same sort of thing with evaluation. If there's certain limitations to those models, like for example, it's a flat or it's a high value property, well, cool, we just go to another bank that it works. So I'm not sort of really worried about sort of specific lenders, but really the market more generally. So the point of this being is that I've not had to say no to any single client I've dealt with in the last 2-3 months. They might not have got the best rate on the market, or might not have gone to the first choice lender, but with rates being so low, which we'll touch on at the end, it really doesn't matter. Everything is just so cheap. So it sort of works for everyone. I say most people that have been BAU, which is business as usual. I think over 50% of banks haven't changed their criteria, which I think is quite staggering. But nearly half of high street lenders haven't made any changes to their criteria. They're looking more closely. For example, if you're self-employed and you work in hospitality, like a good friend of mine, obviously there's lots of questions going to be asked. If you work in healthcare, or for finance like us, well, it's sort of like we're relatively unaffected. So you do have to ask those questions, but it's pretty much been business as usual. One thing that's really come in the last few weeks, as a little note of caution, is that banks are actively checking their pipeline. So let's say, for example, 2 weeks ago we apply for our loan, and then a month down the line you get your mortgage offer, or you come to complete. Banks are either asking us to confirm your position, so has anything changed, has your income dropped, have you gone on furlough, etc., or they're asking you directly. So that's quite normal. So if that's part of your experience, if we ask questions or the bank asks questions, that's normal. Don't think I'm being picked on. The news, particularly the last sort of 24 hours, has been quite negative in the economic sense, so I don't need to really sort of go on about that, but there are people concerned about that. Which leads into that next point about furlough. People think, well, can I get a mortgage, can I not? Well, banks will still obviously offer you a loan, but only the furloughed income. And I know there's quite a big variance in how this sort of works. So again, I've talked to lots of clients over the last few months. I've seen people take pay reductions, people being on furlough, some people on furlough, but then the lenders top them up on income. So there's lots of little variance around this. So the point being, and this is like a golden rule in mortgages, is that whatever you're being paid tax on, you can use as income for a mortgage. So as long as that income supports the loan, then great. And that's also your household income. So not just you, your partner, whoever else is on the mortgage. But let's say, for example, your income has gone down a lot, or stopped, or heavily reduced. There's something called a PT, which is always an option. So that's called a product transfer. So there's a sort of simple rule on this is, if you've paid all your mortgage payments, your existing lender will offer you a new product when you come to the end of your time. So when you come to remortgage, we normally do one of two things. We normally pick up with people a good length of time ahead. So we normally start talking to people about 6 months out from their product, because that's the earliest you can possibly apply. So we say, right, well, which lender's best for you in the market right now? We sort of say, right, this lender's best for you. Then about 3 months out, we then cross-compare that with your existing lender. Say, right, well, you're with lender A, so it's Barclays or Santander. What are they offering you versus what we've got on the table? And if it's better, we'll ditch the remortgage application, stick with your bank. And if it's no better, then obviously we'll carry on with plan A. However, if your situation has changed, which I alluded to there, maybe it's more viable to stick with your bank. So that's always an option. And just to be really clear, we have options for all of the existing banks that's out there. And I can't think of a single exception where you won't at least be offered the same deal coming through us, or a better one. Like with Halifax, Nationwide, sorry, not Nationwide, but NatWest, and a few other really big banks, it's cheaper to come through us to go back to your bank, which not a lot of people know about that. So now at the moment, we're sort of doing it because I spoke to HSBC last week. They think 99% of all applications are coming through brokers because the branches aren't open and people can't get hold of people. So, that's going to continue. So my big sort of thing is, don't just revert to going back to your bank, because I know it's like the inertia thing and it's easy, but just check in with us. If nothing else, you just know you got the best deal. hopefully this is just, oh, there we go. Right, so next big question. So this has been a big talking point this week, is like, how do I know how much my property is worth? Now, without getting all sort of philosophical on you, something being worth what someone's going to pay for it, the two things I sort of look at quite typically is Zoopla, which is fantastic, and I'll send these slides at the end because that's an embedded link specifically to the house price index, but it's pretty easy to find. Also, Nationwide is very, very good. So I mentioned before about that desktop sort of valuation. You can pretty much see what Nationwide are going to do. You put in when you bought your property, how much you bought it for, where it is, and they'll give you what they think it's worth today. So when we come to refinance, people will generally do a quick sense check on that. Now, obviously, that's fine if you bought a property and didn't do any work to it. If you've done an extension or refurbished a property, obviously that may not work, but it's a good yardstick. So that's a good starting point. And then subject to doing work, obviously, then that also will apply for that one. Have lenders passed on the full benefit of the recent rate cuts? Simple answer is no. And again, I'm going to talk about rate a bit more specifically at the end, but it'd be very simple to think, a table I'll share at the end is that rates obviously dropped quite a lot over the last sort of few months. But mortgage rates have stayed relatively stable. I'll explain that in more detail at the end, but I think the only time we're really going to see a drop in interest rates is really Q4 this year. And why I think it's going to be at that point is twofold, because one, it's sort of a lockdown impact. So I say most banks now are running on heavily reduced staff or people working from home, and they really weren't geared up for working at home. So the service-wise has been hit quite bad, but simply people adjusting, people getting back to work, by Q4 this year, I hope we're sort of getting back to a relative norm of working, or certainly a lot more effectively. So if banks have got their capacity up, they're going to get to the point at the end of the year where they're nowhere near hitting their targets, because the issues we've got now are not around money. There's plenty of money, the government's proving that. So banks literally can't get it out the door fast enough. So they're going to get to the end of the year, miss their targets. They've got plenty of money to lend. The only way to buy market share is to drop rates. So that's my little crystal ball thing. And just a little caveat, I have been wrong on this many times before, but I do genuinely think rates will sort of drop around that point. So it's something just to sort of bear in mind as and when you're sort of coming to refinance. Again, if you want to borrow, people ask, well, can I borrow extra money in this environment? 100% you can. There's a sort of little caveat that banks apply. There's two caveats there. One, it's for any legal purpose, so you can't just get a brown bag and go down to Columbia or New York or sort of wherever you want to do, obviously personal proclivities aside. It has to be for legal purpose. So typically it's like home improvements, buying other property, that type of thing. And obviously you can consolidate debt, which I'll come back to in a minute. That can make sense. We're not a big advocate because there's no point just eating away the equity in your property, and there's a big difference between sort of leverage and debt, which I may or may not get into today. But just one, from a regulatory point of view, the FCA are very concerned about people continually paying off their debts in their property because it eats away their equity. And something with, as a principle, now there's nothing wrong with doing it. And if you need to do it and it makes sense, 100% we'll do it. But I'm just saying, let's think about it, because there's lots of options out there. 0% credit cards, overdraft, etc. There's lots of other ways we can manage your affairs where you don't have to secure debt against your property. That's really the main point. So subject to sort of, you wanting to do sort of a legal purpose and you afford what you want to do, even through the downturn, there was also through the lockdown period, there are a few clients I helped release money for various different reasons. Absolutely wasn't a problem. Now I've got surveyors back on the road, completely cool. I sort of alluded to this a few times, that when are things going back to normal? I sort of said there before, it's the end of this year, I think, is sort of when we're going to have sort of full capacity back in our market, because, I sort of survived 2008, and if your camera's good, you can see the grey hairs, so they sort of stem from that, really. That was really sort of supply issue, i.e. there was no money. And when you're a bank and you've got no money, that's a problem. You roll forward to today, this isn't a supply issue, this is a capacity issue. So banks couldn't have surveyors on the road, that was difficult. They haven't got their staffing officers, that was difficult. So there's different challenges. That's why lending's dropped. It's not because there's no money, not because of those same issues in 2008, because banks are really well capitalised. But it's not the capacity stuff, and it's going to take time. And I'm having to sort of dig at the government there about their clear guidance. It hasn't been very clear, and I'm not going to get into political debates, but it's extremely difficult to unpick this situation. So there's going to be a post-mortem. This is going to go on for a very, very long time. Who knows who's got it right? Did Sweden get it right? Did we get it right? Who knows? But it's very complex, very difficult. So, but I do think it's going to take quite a bit of time. That's sort of my point. Right, so that's sort of where we are sort of currently. And there's a few sort of like historic golden rules I just want to explore in a bit more detail now as well. So one of the biggest things is how to improve your credit score. So there's two aspects to this. Which I'll just explain very, very briefly. The first point is your credit score when you dial into Experian, Equifax, or Model, or Credit Expert, whichever one you sign up for. That's very subjective on what that company can sell you with their ancillary products. So that doesn't necessarily relate to your credit ability for a mortgage. So a classic example is if you've just got a current account, no credit cards, no debt, no nothing, you might have quite a low credit score, but a bank will offer you a mortgage all day long. You could have lots of debt, but it's all very well maintained, but a bank might not like that, so they'll give you a low credit score. So you just got to sort of weave your way around this. So what I'm saying is, if you've got a high or low credit score on your credit rating when you look at it, don't read too much into that, and we can sort of talk you through what that means specifically for mortgages. One big issue we see, which is always the point I put first, and this is a real London issue, is that where we see most people declined for a mortgage is simply because their address history is incorrect. And if you haven't done it, I urge you to do it. And I'll share a link at the end of this with you as a follow-up email, how you can check your credit score if you don't do it already. And you might see if you've lived in a number of flats. So let's say, I remember when I first moved to London, I think I lived in 3 different addresses over 3 years, and they're all flats, and they're all sort of flat shares and stuff like that. So it's some stuff with my parents, some at one address, some at another. And I found that the formats of the addresses were slightly different. It might be flat 1 or flat A or 300 and whatever it is, the address you've got. And it's all slightly different formats. If it's different formats, what can happen then is a bank doesn't see you effectively. They can't find your online credit footprint and actually decline you for a loan. Normally, with a bit of jiggery pokery on our side, we can sort of just match up the addresses and make it work. So this is that swan effect. You may never see this if you deal with the brokers. You might be declined first out, we change the addresses, we make it work. It's just because they can't match the addresses. So what's a really, really good little tip, this is like the biggest tip I can give you to take away, is look at your credit report, look at the format of your addresses, make sure they're all the same. So it might be the same address formatted differently. If you're not sure about it, I'll talk through any sort of specific examples. You feel free to sort of pick up with me after this, but you'll see what I mean. And if they're not the same, write to the companies that have that. Say if one's with BT, one's with your bank, and one's with your mortgage provider, just write to them and say, look, can you please put my address as like whatever it is. And what I would say is for guidance as what's the correct one, check on Royal Mail, because that's what most banks do. Banks look at the Royal Mail address finder. So as long as yours matches that, that can be the difference between getting a mortgage and not. Sounds like a really pathetic thing, but you can control that. And it just means that you can do that now before you apply for a mortgage. Doesn't mean you have a few months of back and forward trying to sort that out at the time. Obvious one, which I think is sort of common knowledge now, but repay your debts all in full each month. That really does boost your credit score. Don't take payday loans. I'm not sure this is public knowledge enough, and if you have, whatever, certainly through this period, but just so you know, the rules around this are quite clear. Pretty much every high street bank I can think of will decline you for a mortgage if you've taken out a payday loan in the last 12 months. They're pretty clear on that. Some if it's in the last 24 months. Now you can argue, like, I took a loan, I paid it on time, I paid it back, like, yeah, completely cool. But that's banks' policies around that. Unfortunately, I don't have time to go in the ins and outs of that. So that's just a footnote of saying, don't do that unless you absolutely have to. And if you have, just be aware of those time frames. We might have to wait till we're outside of that. Don't have too much open credit. So that's what banks get nervous about, is if you've got 10 credit cards with sort of 0 balances, but 10 grand limits on each, they get worried that you could then move into a property or refinance and then rack up a load of debts. That's a little footnote, is if you aren't using credit stuff, just close it down. Don't apply for lots of credit in a short space of time. Very simple principle to that one. And occupation is a huge factor. So this isn't captured on any credit reference agency you look at particularly. But what banks would do is, if you're a classic professional, so doctor, dentist, accountant, etc., if you're in those professions, banks like that, because exactly as we're seeing now, those professions are recession proof and pandemic proof, it would prove as well. So you'll find that the score is weighted as to sort of what you do for a living. This is also very subjective. So let's say I used the example earlier, so I'll stick to it. Let's say you work in hospitality. What a bank might do is dial down the credit score. So if you work in hospitality, they might just reduce your credit score because they don't want that risk right now. But you can go into the ethics of that, but that's just how it works with banks. And that's how your credit score works, really. And the point to it being, as I alluded to at the outset, so just finish on it, but it's really to sell you other products. So your credit score is your viability of getting other credit with that credit reference agency, because that's how they make their money. And if you dial online, you'll see, like, compare your loan, compare your credit card, etc., etc. Every time you click on that stuff, they make money. So that's how your credit reference agencies make money. How much can you borrow, and how's your income assessed? So because I'm a bit short on time, I'm going to whistle through some of this. There's some really, really simple rules around this. So pretty much every bank offers you about 4.5 times your income less any commitments. So let's say, I'll pick on myself, let's say my nursery fees are £1,500 a month when they go back. You times that by 12, take that off your income, and it's that net income that banks work from. There's naturally a range. The maximum you can still go to, and there's still 2 banks doing this, will offer you 6 times your income. Most of the big banks, most of the big corporates, Santander, Halifax's, etc., they'll get to around about sort of 5 times your income. Now, how income is assessed is a whole different ballgame, because if you're employed, so if you take a straight salary every month, okay, that's really easy. If you're like me, for example, I'm a limited company director, I've got a salary, hopefully some dividends and other bits that sort of come out of that. Very, very different assessment. I don't have time to get into that now, but all things aren't treated equally. For example, dividends, a lot of banks gross up. So, 5 times lending with one bank isn't the same as 5 times lending with another. For example, some banks only take 50% of your bonus, some take 100% of your bonus. Some people don't include your net profit, some do. So that figure is slightly misleading. And again, it goes back to that point about variable income. So if you're variable income, you have to go to the right bank to get the right outcome. And if you just rely on your basic, then you're cool. But anything outside of that, you have to be careful of. Contractors, which we deal with a lot of, what most banks do is deal with your daily rate. Obviously, I'll come on to this in a bit more detail in a second, but it's quite a simple calculation on this. So if you know what your daily rate is, you times that by the days worked, and then you times that over a 46-week year. So if it was, I probably should use a calculator for this, but daily rate times 5 times 46, that's the figure that banks use for you to assess your income. So even if you run yourself through a limited company, they sort of ignore that. I mean, you can do it as a self-employed basis, you can do that, but you'll probably find your day rate calculation is much more favorable because, like me, like anyone, if you run a business, you run a lot of costs for your business and keep your costs down. So just a note on contractors there. Now, I've said here, normally I spend more time on this, but it's more of a footnote at this stage, is that, and I've alluded to it a few times, so I won't talk about it in great depth, but all income at the moment is being questioned. So banks are going to look at the sector, your role, how's your income made up. So this is normally something I'll talk about in terms of which is next, about what you do for a living, what's your track record, what's your income look like, whether there's vesting stocks, options, all this sort of stuff. The reality is, at the moment, if you have any variable income or element to your income, please speak to special advice. Naturally, we're here to help you. That's what we're geared up for. But speak to any advisor that will help you through it. Don't just go to your bank and potentially get a bad outcome. That's what I would suggest. As I said at the outset, 50% of banks still haven't changed their credit policy. So there's always a home for you. You just need to know the right one. So I'm not going to go on in any great detail. Point being, if you have variable income, self-employed, or something that's just non-regular, please get advice, because there's a home for you, but you just need to know where that is. Now, this is my favorite slide because it shows you how to save lots of money. Now, this is picked out of a recent example, a client I helped a couple of weeks ago. So this is all like a generic thing. So the numbers work pretty respective of this. So they're borrowing roughly about £500,000, and there's 28 years to run. And their rate 2 years ago was 1.74. So their payments were about £1,880 a month. Now, a couple of ways you can approach this. You could just do a like-for-like switch, which there's nothing wrong with this. You could keep the term at 28 years. The rates have dropped about 0.5% since then, so then I get a new rate of 1.3 on a 2-year fixed rate, which means your payments go down to £1,777 a month. Cool, that's great. However, what we would recommend is that you reduce the term by 2 years to keep your payments broadly the same. Okay, it's £10 more, but by paying £10 or more and reducing 2 years off your mortgage, you save you £11,000 717 over the lifetime of a loan. That's phenomenal. Now, what you tend to find now is a very weird time, but generally over time, your income steps up and debt stays flat. So you can start to pay a debt off, certainly faster in the later years. So this is a principle I really stick to. And as a point there, I'd much rather have the money in your pockets than a bank. That's what we're about. I'm all about putting pounds in your pockets, not bolstering your share price. And it's obvious, but I'll sort of finish on it anyway. Now, let's say, for example, your income has gone up, which does happen a lot. You sort of think, well, actually, I can afford a bit more than what I'm paying currently. Well, if you reduce the loan down just by 1 more year, so just 1 more year off that, so taking it from 28 years to 25 years, that saves £25,000 over the life of the loan. It's huge impacts here. So this is what I was saying about getting people debt-free faster and managing debt down. That's very much my mentality, is let's manage debt down. So if we can, I think interest rates are very low and going to stay low for a very long time, which I'll touch on in just a second. Now is a great time to really, really pay off some debt. So that as a principle, that's some numbers. I would urge you to go down that path if at all you can. Now, if you still pay it off over the term, great. But that's how you can do things a hell of a lot faster. Now I'm just going to sort of spit this one at you because I'm relatively short on time. But I read a great book a little while ago. If anyone's aware of it, it's called The Richest Man in Babylon. It's written about 1942, 1943. It's written in sort of King James Bible language, which is very sort of reminiscent of my childhood. So I quite like. I listen to it in audiobook as well. So if you like that sort of thing, it's cool. Now there's lots of principles in the book, but they've got sort of this 3-step process which I've pulled out, and this is basically like financial advice 101. And everyone knows the first part is buy your own home, pay off the mortgage. We just talked about that. So that's sort of relatively common sense. This is one that gets lost. Save 10% of your income and invest for the long term. Now, many of you, if you work for a firm or got a pension, okay, that's brilliant. Some of you might have a buy-to-let, that's fantastic. But you do need to put money aside, even if you're paying down debt. Where I see people get wrong is often heavily deleveraging, so paying off mortgage really, really quickly, but not saving for the long term. You do have to do the two in tandem. So just bear in mind, that's like the golden figure, and do some maths on it, speak to an IFA. They'll run you through the benefits of doing that. And protect your income and assets through those 2 steps. So point being is if you're sort of 10 years down the path of paying off a 25-year loan and you lose your job, you get sick, you get cancer, or God forbid someone dies, you know, that can throw all your plans out the window. And I think the line in the book is something, if you don't insure against loss, you will suffer loss. And that's why it's there. Now, obviously in this environment, I'm not going to talk about it in any great detail because it could be insensitive, but it's something we do talk about a lot, is you need to protect your income and your assets, otherwise you don't become wealthy come retirement. I know people have sort of connotations around the word wealthy. I mean, wealthy just simply means, you know, you've got more income coming in than you're outgoing. So it could be a case of, you know, it costs £2,000 a month to run your household. If you've got £2,001, you're wealthy. You don't have to be a millionaire to do this, and you can manage your affairs quite modestly. Now, if you want more, you do more, it's great. But it just means getting yourself ready so you're not reliant upon anyone, which I think is a goal that most people would share. And if you do have debt, so they just slide the principles around. So still take 10%. And again, this is, like I said, where people go wrong. Even if you've got debt, make sure that you have 10%. 20% should go to your debts, and then 70% you can live on. So just make sure things are in those proportions. And if you do your maths and it doesn't work, you've got 2 options. You know, earn more, which works, or restructure your debt. And that's where we go back to debt consolidation sometimes being a good thing, because if you can structure it, get paid off in those proportions, great. But, you know, just try and use that as really, I know it seems stupidly simple, but so few people do it. So if you're not doing that, have a look at that. And just to finish off just for a minute or two, is around our view on interest rates. So if any of you are avid readers of our weekly updates, I'm sure you all are, but God forbid if you're not, or if you've missed a few, I literally post this every week, and I do it every single week, and I've done this for, God, years. You might be able to see my cursor, hopefully. Now, I'm just going to roll back a little bit to give a sort of context. If you go back here, this is sort of good. So any of you with an economics background, forgive me for the simplicity of which I'm explaining this, but the blue line here is 5-year money. This sort of brownie line here is 2-year money. And this silver one is what we call LIBOR. So that's London Interbank Offer Rate. That's actually what banks lend to each other at. And then the gold line here, most people are familiar with, that's the Bank of England base rate. So most people are sort of fairly familiar with that one. Now, we look at money rates a lot more than we do Bank of England, certainly. Obviously, we look at where things are headed. So simple rule, and excuse for the simplicity, is that if money market rates are above the Bank of England, that's generally good, because it means the economy is moving forward. Certainly low interest rate environment means interest is going to rise, the economy is going forward, that's a positive thing. If they fall below that point, which is here, that's generally a bad thing. So it's sort of saying the economy is going backwards, we're going to have to cut rates. It's generally not a good sign. So to come on to that, this period here was a no-deal Brexit. Remember that? That felt bad. Let's go walk in the park now. That triggered then a second election in a relatively short time frame. The Conservatives got in, no matter what your political views are. Markets like certainty, so it looked like they were going to get a good 5-year run. Then obviously December, January, news starts coming out of China, and that takes us to where we are now. So I don't think the rest of that needs explanation. But what this means in terms of mortgage rates, if you do the maths on this, so 5-year money is about sort of 3.5%, sorry, 0.35%. So that means markets have only priced in 1 base rate movement in the next 5 years, which is phenomenally pessimistic. So this goes back to what I was saying about managing debt down. This is a period where you really can hammer your debt off. So, and I personally, I'm not going to get to a whole economic debate now, but particularly with myself in this format, but I I do think rates are going to stay low for 5, 10, 15 years, because I think it made a lot of press, if not this morning, yesterday, that our government borrowed 6 times the amount last month than they plan to all year. So that really puts it into context. And the only way a bank or any government, can pay back that level of debt is in an ultra low environment, ultra low interest rate environment. So I think rates are going to stay low for a long time. So I would suggest you don't take a 5-year fixed, because rates aren't going to go up. So there's a premium on a 5-year to pay. Well, why pay that premium? I saw people take a lot of 5-year fix in 2008 and were disappointed because rates tanked. I saw a lot of people take 5-year fix around Brexit because they were worried and the rates went down. Obviously now everyone's worried interest rates are going to go up. I don't think they're going up. So that's just my experience over sort of my career, but I just don't see how you're going to win through that process. I would much rather continue that cycle of managing the debt down and put more money in your pocket. Cool. Right. So for all these sorts of wonderful updates, you can look at us on LinkedIn. So if you haven't, then I'll share this later, but find us on LinkedIn. Pretty easy to find. I post this every week and some various bits and pieces that we're up to. And I think that comes out for any questions. So if I come out of this now, I think I can see any sort of comments. So, right. So if anyone has any questions around that, please feel free to pop a question in the box. Tom, so am I able to circulate the slides after the meeting? Yes, I will. So everyone's on this meeting, so I'll do it as a blind copy so you won't see each other's details, but yeah, absolutely very happy to share the slides after this meeting. Also, what I do is I'll put a link for a free credit report as well, the one that we recommend. It's for the credit expert guy, so hopefully you can see that as well. And any other questions at all? Or have I done such a superb job? I've answered your questions. I'll be impressed if I have. Oh, here we go. Sorry, this isn't updating. There we go. Stuart, thank you. Will banks factor in offshore income / assets? Yes, they will. This goes back to the sort of the more complex aspect. So as a rule, and I'm applying a very big rule, but banks with an international footprint, so your Barclays, your HSBCs, are more inclined to do that. Ironically, small building societies are really, really good at that as well, actually. So yeah, it's not a problem, but I'll go back to the golden principle. If you're paying income, it's evidence. Well, I appreciate you may not be paying income in traditional sense, sorry, income tax on it, but yeah, but that is factored in. Cool, so I can't see who wrote this question. Oh, Ivan, I think it is. Oh, sorry, a bit tricky. What should I be aware of if I'm remortgaging next year in the summer for 2-year term, but I'm planning on doing a loft conversion beforehand? So what should you be aware of? Well, there's not too much to be aware of, really. It depends whether you want to borrow the money to do that or not. I mean, if you've got the cash to do it, great. You know, what we can then do is get sort of projected values about that. Or if you're looking to sort of do the work and borrow the money, the sort of 2 things you could do. You can either wait to the end of your product term, or what you can do is most banks offer what's called a further advance, which again we can organise for you. For example, literally I'm doing my loft at the minute, so that's costing X amount of money. If you want to do that, we can apply for extra borrowing with your bank now. Really important point is to make sure that the product end date doesn't conflict with yours. So I don't want to get into too much detail now, but you can borrow a little bit of money, make sure it's penalty free, for example. Then when you come to refinance, you wrap the whole thing up. So either do it at the end or during, but again, talk to us and we can talk you through it. So a few questions coming through quick now. Chris, how quickly could I remortgage today? Good question. The quickest mortgage offer I've got out, and this was during lockdown, was 24 hours. It can take 4 to 6 weeks. So quite a range there, Chris. Sorry for not a very clear answer. Obvious answer being is the simpler it is, the quicker it goes. So for example, the quick offer I got was a lady who worked for the NHS. It was a simple salary with a very low loan to value. So went through all the automated systems, flew out. If it's more complex, it's going to take underwriting. I would personally say allow 6 to 8 weeks to refinance. Just allow that to happen and you shouldn't be disappointed. We can get it through quicker, but just allow that sort of time frame. So I'm going to speak a bit quicker now because these questions are coming through. So I can't see who answered this question, but do you think that the larger lenders will lead the way in Q4 with potential product cuts, or will smaller lenders be the first to move? Invariably, it's always the big lenders because the smaller lenders tend to pick up in niche areas. So, for example, they can't compete on price. So what they tend to do is compete by, for example, the guy with the offshore income. They say, well, actually, we'll include offshore income, but say, for example, like Barclays don't like that. So no, it's always the big guys who pay the way. It'll be your HSBCs, your Santanders, your Halifaxes. That's typically who lead the charge. Adam, when remortgaging, how do banks view couples' joint income if one partner is on a statutory maternity pay? Excellent question, Adam. Banks have to take the pre-maternity pay on one caveat. As long as their employer will confirm you're going back on the same terms, then they'll take the pre-maternity pay. If you're going back on reduced hours or part-time, then we'll take whatever the new income will be. So even if you're not earning right now, banks do have to take either the pre-maternity pay or post if there's been a change. So what we normally do is write to the HR team or the company owner. They clarify that, and banks will use whatever income is confirmed. Will, need to remortgage by October. Would it be a benefit to wait and take advantage of potentially lower rates in the summer? It's very dependent on your situation, Will. I would urge you to secure something now. Even the small and the HSBC cut their rates. Now, while I think rates will dip a little bit, it's not to say that will happen. My crystal ball comes with a huge asterisk attached. I have been wrong times before, but I would always urge you to apply early, secure a good product now, because you can always switch later. If something good comes along, just jump on a different horse. So I would always, don't wait, particularly if and I don't want to get pessimistic, but let's say there is a second wave of infections and we go into a second lockdown. It's such a weird time. Don't run that risk. So just take advantage now, and we can always change later should we need to. Kendra, what happens if you're currently on a fixed rate for another 2 years? I've added an extension refurbishment. Would it make sense to remortgage now or wait until the end of my fixed term? I would probably say, Kendra, it's probably worth waiting, because unless there's it's a penalty-free deal, you've got to suspect the sort of exit penalties. It's worth a chat, because depending on when you took your deal out, because rates have come down so much, it sometimes does make sense to pay the penalties and get a lower rate. So that's certainly worth a conversation, but we can just do the numbers for you. Say, look, this is what you've got. This is the cost of moving. Does it make sense? Or it's a really simple number crunching exercise. So drop me a line after. I'm happy to help you out on that one. Chris, houses in joint names with my wife. Oh, sorry, moved. When I remortgage, does it have to be in joint names, or could it just be in my name? You can do it in single names. So you can move people, and particularly, I think you said you're married, so transfer of assets between spouses doesn't have a tax connotation, so nothing to worry about in that sense. All I would say, there was a very famous legal case about 2-3 years ago against Santander, where there was a married couple. I think it was Mr. was on the mortgage, but Mrs. wasn't. Mr. stopped paying the mortgage, but they couldn't evict Mrs. because she obviously wasn't responsible for that. So what a lot of banks have done since is say, if you're married, you both have to go on the application. So that could be one way you say, look, if you don't want to be on the application, it may not be that we go to the cheapest lender, but we go to a lender that allows that. So that's quite a long answer. Sorry, Chris, but it's just something to bear in mind. So you can do it, but lenders have swayed away from it, because if something goes wrong, though, they can't have full recourse to pay off the loan. Oh, no problem, Kendra. Cool. So we've gone on sort of 10 minutes, but everyone's posting questions and still quite a lot of people here. So I'm guessing you're still finding this mortgage chat on a Friday morning interesting. So thank you for sticking around. But I would say, I was going to say, Stuart, do the most mortgages have an offset account? Short answer is no. Offset is a specific product. So what you tend to find is that most of the big guys offer that. So they offer an offset product, but it's a separate product. And there's normally premium to pay. It's anywhere between 0.3 to 0.5% more than a traditional product. So again, another number crunching exercise is how much do you have in savings? What's the mortgage rate and does it make sense? Simple rule of thumb is if you've got more than like 10% of the mortgage balance in savings, it generally makes sense to have an offset, but it's down to your specific circumstance. But that's one that needs a bit of number crunching, Stuart. So no, it's not an option. It's a specific thing you have to apply for. My pleasure, Stuart. Cool. Well, I'll just give it a few seconds more. So unless anyone has any questions, I think we've got to the end of that. So thank you for sticking around. Sorry, I tried to make it short, but as you're asking questions, I thought we'd stick around for a bit longer. So hopefully that's been useful. As I said, I'll circulate the slides and also there's a couple of bits I mentioned. And if you're working with us, great. And if you aren't, you should be. So please pick up with us. We're always very happy to help you out. Please look at us for LinkedIn for other bits and pieces. And if you need any help, we're really easy to find. Look at our website. Everyone's got their contact details up there, including myself, and we'd love to help you out. So hope you enjoy the rest of your Friday. Thank you for joining, and hope to speak to you guys soon. Thanks again.